traders and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter. And here's what's coming up on today's program. Oil rises, tensions soar after a tanker carrying fuel is struck in the Red Sea. Iran distances itself from a separate attack in Jordan in which 3 U.S. soldiers were killed. Hong Kong court orders a liquidation of the world's most indebted developer, China Evergrande, in a new test for the embattled property sector. Plus, Philips shares fall after the Dutch firm halts a sale of sleep apnea devices in the U.S. following a settlement over faulty equipment. So first of all, happy Monday, everyone. It's going to be a really, really busy week. We have the Fed, we have the BOE, and we have a number of other events. It's a really event-packed week, which is why actually stocks for the moment are a little bit cautious. Now, markets really opening the week on this cautious note. Again, what traders want to know is a lot of the outlook for interest rates from the central bank. They're also bracing for a deluge of earnings. When you look at oil prices, they're pretty much gaining after these Middle East tensions seem to escalate. But it is really a lot of the companies, for example, Holcim saying it plans to spin off its North American business, Philips down. There are a lot of also individual stocks that we need to look at very closely. Now, we're also joined by JP Morgan's head of global multi-asset strategy, John Bilton, also with us, Bloomberg's Justina Lee. Now, we'll get to you in all the central bank action. I know there's plenty, John, but first let's also go through the latest twist in the Evergrande saga. So, Justina, I mean, Evergrande, I feel like we've been talking about this for 4 years, 5 years almost, and it was, it could default, it couldn't, but now this is actually a huge deal because the authorities let it go.
Right. I mean, this case was originally brought to the Hong Kong courts by a creditor. And I think all this time the judge was waiting for some sort of restructuring deal. But since Evergrande never really put one through, now the court has ordered this liquidation. And now it kind of remains to be seen how it's going to be executed, given that a lot of Evergrande's properties are run by local units. And also it remains a question kind of how are you going to execute a court order in mainland China? And I think that's what a lot of investors who have invested in Evergrande's, dollar bonds are wondering right now.
But, Justina, I mean, through all of our reporting, does this spell trouble for the broader sector, or is this almost like a one-off?
I mean, a lot of kind of other property developers have also walked down the same path. But I think the problem for the broader sector here is that it's possible that it could affect Evergrande's ability to finish a lot of their remaining projects, their pre-sold homes. And if they cannot do that, that could potentially affect broader sentiment. I mean, it's reminding the Chinese people once again that these pre-sold homes may not be as reliable as you thought.
Yeah, and John, there's plenty to worry about. First of all, thank you so much for getting us started on this busy week this Monday morning. But, this puts in the spotlight basically the possible property crisis that could unfold in China. There's a lot of worry about, tensions in the Middle East, maybe a possible mistake by central banks. Like in this wall of worry, what concerns you the most?
Oh, I love that phrase you use, wall of worry. It certainly felt like that at the beginning of the year, hasn't it? I don't think from an investor standpoint anything has necessarily new come out of China on this particular angle. I mean, we know there's been this property issue for some time, and we're caught in the cross currents of a market which is getting some technical support, things like the short sale ban on some lines of stock, which could give you a little bit of a pop in some Asian indices. But at the same time, the underlying momentum of the economy over in China remains sluggish. By contrast, of course, the US is going gangbusters. So, I think we're still in this world where if we pare it all back, it's a very asynchronous cycle. Now, to the downside, that means that actually if you've got one region accelerating while another is cooling, it prevents the risk of a big synchronised slump together. But at the same time, we've got no business expecting that coordinated upswing that might give, that whole Goldilocks scenario many people talked about at the beginning of the year some legs.
But so, John, I mean, my concern is that when you look at some of the earnings forecasts, or at least equities and what will support equities, you really have, there's a mismatch with so many big banks and what they're expecting. And I don't know whether it's because it's hard to read or that's also an inflation play.
Well, not really. I mean, there are some pockets where, you could argue, and I've seen it written, stocks are priced for perfection, tech sector, for instance, and people worry about the expectation there. But the reality is these are companies that are compounding 15 to 20% growth, a 5% free cash flow yield. There is a lot of money being spun off. And I mean, ultimately, we do think the tech sector can grow into parts of its valuation. What concerns us a little bit is that we've seen a little bit of narrow leadership this year. Gives us some technical concerns on the index. But if I look at the broad S&P earnings expectations of around $240, $245 per year. We think that probably is, we expect it to come in a touch lower than that, but we still see a decent upper single digits growth in earnings this year, just really from the economic momentum that we see within the US.
And Justina, is there anything in the earnings that actually you and the team are looking out for?
Well, I think it's always comes down to big tech. I mean, as kind of John mentioned earlier, it's kind of funny we're in this situation where the index is so dominated by these mega caps, and these mega caps are also still growing kind of profits at such a healthy rate. But I think given where valuations are, I think it's really important for investors to kind of dig deep and to see if they can actually justify those multiples.
Do you find, John, any value in European markets overall compared to the others, because there seems to be a lot more negative sentiment, which can be justified or not?
I think it depends how you define value. I mean, if you look at Europe sector by sector compared with the US, it's cheap. But at the moment, you've got German IFO coming in weak, you've got a still relatively sort of lackluster economy over here, and question marks as to how the ECB are going to behave with regard to inflation. So, yeah, it's cheap. Is it time to dive in quite yet? We'd argue probably not. Look, don't get me wrong, we're not actually too bearish on Europe. We think that we are towards the bottom of an inventory cycle, and consumers have decent balance sheets. It's just perhaps a little bit too soon. We'd probably see a little bit more value in leaning into the euro at the moment than necessarily the European equity market just now.
But so what needs to happen for you to go into the European equity market?
I think what you need to see is really some convincing signs that the good cycle is turning. We've seen a little bit of that in things like Asian export data. And, of course, don't forget the situation in China. I mean, Europe exports a lot to China, and if that region is in some way constrained, obviously Europe, by extension, gets that constraint on itself. So I'd say it's a little bit of the good cycle, a little bit of sentiment, and then just really getting a clearer picture from the ECB and from survey data that actually the forward looks a little bit better than the last couple of quarters.
When you look at some of the valuations, Justina, I don't know whether there's something that really catches your eye. I know we're looking also at some of the proprietary, like Bloomberg data, to try and figure, do you have a favorite chart or something like that to see whether markets are going up?
I mean, not really, but I think, one really interesting question, talking about China, is that I think last week the Bank of America survey actually showed money is going back into funds buying Chinese stocks again. So we think that's kind of pretty interesting given, how dire the sentiment is right now. And I think if you're kind of looking for value plays, if you're looking at China versus, the rest of the world, emerging markets versus the U.S., it does feel like, the value is there in, Chinese stocks right now. But, of course, no one has kind of done any wrong just going long U.S. large caps over the last few years. And I think that's what a lot of investors are sort of just like primed to do right now.
John, do you play China actually through some of the big, maybe European corporates?
Well, I think, remember, we tend to take a look at it from a very regional top-down basis. So when we buy emerging markets as a block, we, of course, cared very deeply about what's going on within China. And it has been a constraint. And at the moment, our concern is that the stimulus isn't quite enough. No. Some of the issues, such as the property sector, as we discussed a moment ago, are still there and hanging over sentiment. And, and ultimately, as you say, you have a domestic market in the US, which, frankly, continues to really lead global equities. And if you're looking at money flow, right now, if you're a US investor, you don't have to look very far afield. And until that changes and we get some positive signals out of the PBOC or Beijing, then I think that we still have a situation where China is a trade, not necessarily an investment today.
Really interesting. Thank you so much, Justina and John there. It's the J&Js. We only have J&Js, otherwise the show doesn't work. Justina Lee, thank you so much. And John Bilton, of course, stays with us. Coming up, pressure on President Biden to confront Iran after a deadly attack on U.S. troops in Jordan. We'll bring you the latest on that next. This is Bloomberg. U.S. President Joe Biden is under pressure now to confront Iran after 3 American soldiers were killed in a drone strike on a U.S. base in Jordan. Well, Iran says it had nothing to do with the attack. Well, joining us now is Bloomberg's MEA News Director, Rosalind Matheson. Rose, thank you so much for joining us. Fears that we almost have on a daily basis really seem to be escalating, that there could be, a growing conflict.
Well, that's right. Obviously, this latest development will force the US to react in some fashion. The question is when and how do they have to attack Iran directly in some fashion, which they've not done for a very long time? Or do they again come through some sort of proxy for Iran in the region, that calibration of response that sort of sends the message that the US is not going to stand for this without spiralling the conflict further? Of course, a lot of calculations for the US president in all of this does not want to be drawn into a long-running conflict in the Middle East. Bit by bit, they seem to be being pulled in. Doesn't want that to happen. Of course, the US election cycle is very much a factor in his mind in this. So the question is, what can they do in a way that sends a strong message to Tehran and its proxies around the region? Because how much of these proxies even listening to Iran anymore? That's also a question. So a lot of things for him to consider in working out how they're going to respond and when.
So Rob, because we're in an election year in the US, does it mean that he would respond actually harder or softer?
Well, that is the question. You can see overnight some of the conservatives in the US were split on this. Some were saying you've got to hit Iran and hit them quickly and hard, and others saying no, because we're just going to get pulled in further into a war we're going to regret. If you look at history with the US around the world, Afghanistan, Iraq also, littered with these cases that the US has found itself mired in for many years to come. Do you want to be doing that with US troops very much physically involved and in peril in an election year? That's something that will play very much into his thinking.
And do we have any blueprint of what Donald Trump would do in this case?
Well, Donald Trump may say, of course, that he would resolve this conflict very quickly. That's what he normally says about these things. He's promised to end the war, Russia's war in Ukraine, very quickly also. But he, again, in the end, was pretty shy about putting US troops physically at the front line in these things. He talked about pulling the US out of Europe, for example, pulling out of NATO, not risking US troops anymore in conflict. So he himself might be quite reticent to do that. And, of course, he ordered the attack on the Iranian general Soleimani some years ago when he was in office. But even that was a calibrated response at the time. So much, and no one's going to have an appetite for war here.
Ross, thank you so much. As always, Bloomberg's MEA News Director Rosalind Matheson. Now, still with us, JP Morgan's Head of Global Multi-Asset Strategy, John Bilton. John, when you look at the risk actor, the risk out there, even VIX, markets have a really hard time actually factoring a possible escalation of conflicts around the world.
Yeah. I mean, we don't tend to look at things like equity markets and bond markets as being a particularly good way to play geopolitics. I mean, geopolitics is highly sort of volatile and stochastic, as we just heard. And instead, what we think about is, how do we manage our risk appropriately, and where will the risks manifest themselves? And in this case, it's clearly the oil price and parts of the shipping market that are really feeling the acute pinch. What does that do? Well, shipping probably pushes inflation risks a little bit to the top side. But remember, we've been mostly concerned about services inflation. So, while this is obviously a deeply worrying situation, the actual pass-through to headline economic data is somewhat muted. And then as far as the oil price goes, of course, we know we've got countervailing measures that OPEC themselves can take with production. We also know that, the impact on inflation of higher oil prices, while it pushes up the headline, actually, because it hits consumers in the pocket, sometimes it can push the core down.
But so when you look at, for example, the reaction function of, the Bank of England or the ECB and the fact that a lot of people are saying, look, they're behind the curve in cutting interest rates, does geopolitics and a potential spike in the oil price come into their thinking?
Well, certainly with someone like the BOE, they're really walking a bit of an arete here. Yeah. Because on the one side, you do have this risk of inflation, and certainly the UK is more of a price taker in international markets, so is more prone to these inflationary shocks. On the flip side, of course, we all know how the pass-through of rates hits the mortgage market. So if you're Andrew Bailey, this is a real tightrope to walk. And I think anything that starts to show a little bit more credibility around the Monetary Policy Committee, thinking about how to weigh these risks up, I think will play very well.
But, John, what's credibility? Is that they're worried of cutting and then having to reverse it? Or they're worried of a sudden shock in inflation? Or how do you regain credibility in this kind of scenario?
Well, I think communication above all else. Look at what the Fed and the ECB do. They talk a lot back to the market. They're in a position now where what Jay Powell says, what Christine Lagarde says, actually has as much impact on markets as what they actually do. I don't think we're at that place with the Bank of England as yet. And I think really just seeing some cohesion from the Monetary Policy Committee, a little bit of guidance as to where do we actually see the economy going, when can we expect inflation back to target, do they have something in their mind in terms of the real bank base rate that we'd expect to see? That starts to really, I think, rebuild it and get it back onto an even keel. But it's a tough job for the Bank of England.
Yeah, but I feel like the market is just not listening, for example, to Christine Lagarde. I mean, she said twice that nothing will happen for the summer. They're still pricing cuts in May. or even March in some cases.
And I think that reflects actually a lack of sort of common view across the market. There's a great deal of different camps out there. I read one part of the market that's still saying we're heading for a recession. Another part of the market that's saying it's Goldilocks. How do you price for that? And I think ultimately what we're seeing is the fact that we just have a quite diffuse set of views. For choice, I think March is too early. I think having seen some of the data that came out of the US over the past few days, you're certainly seeing that the jobs market's still reasonably strong. You had CPI print, which were pretty high. GDP, just look at that. Yeah, that's a tough call. But certainly the Fed have got to be paying attention to what the real Fed funds rate is. Yeah. And we know inflation is coming down if we look at the PCE measures. So as a result, I think the Fed have air cover to cut. And I think this is going to be a meeting where they probably come out and set out their agenda for the year more than necessarily promise anything.
John, how did we get the U.S. economy so wrong? I mean, I think you were one of the only believers of a strong U.S. economy. But I remember last year it was like no landing, crash landing. Like, what are we underestimating?
Well, I think a couple of things. And look, I mean, I've spent my career with US firms and I'm known never to underestimate the US.
Rule number one.
Rule number one. But the thing is, I think first and foremost, the huge consumer base that is out there. And ultimately, the American consumer is truly a force of nature. And when they have money in their pocket, as they did with the savings that they had post-COVID, they will use it. Secondly, I think that we probably have seen inflation follow a fairly standard pattern. It was largely a supply-side-led issue, and it's unwinding more or less symmetrically. And I think some of the concerns about the pace of hikes were probably unjustified. And the third thing, and what's most important, is in this particular instance, the imbalances that normally have built up by the end of a business cycle, things like excess leverage, companies over-investing, etc., hadn't really shown up. It's been a relatively short business cycle. So the corporate caution in the run-up to that spike in supply-side inflation, I think left us in a position where companies were able to absorb, households were able to absorb that higher cost of borrowing for longer, perhaps, than many had expected.
A good time to buy treasuries?
Well, we think that as you're entering a period where rates are coming down and the Fed are likely to continue to signal that the next move will be a cut, then history tells us that that tends to play well for Treasury bonds. What's been useful recently as well is looking that, as a multi-asset investor, we're seeing the correlation between stocks and bonds begin to come lower. It had been very high, and that's dangerous if you're a multi-asset investor because you've got nowhere to hide. But as that correlation drifts down, if you're putting risk in the portfolio, once again, bonds are doing the insurance job that you truly want them to do.
Is there anything, we haven't talked about emerging markets. We've gone around the world in like 10 minutes. Is there anything that you want to buy in emerging markets, either FX or bonds-wise?
Well, I think there's some interesting stuff. Certain of the local currency debt markets actually look as if they're giving a decent real yield. Yeah. And certainly there's obviously downward pressure on rates there. And then if we look at the larger blocks of emerging markets outside of China, so the Pacific Rim, actually with the turn in some of the data coming out of Asia, things like the turn in the chip cycle, potential turn in the goods cycle, that's an area which is of interest to us. So EMX China actually potentially beginning to become a little bit more interesting.
Great, John. Thank you so much. As always, JP Morgan's John Bilton there with some great calls on markets. Coming up, more of our interview, the chief executive of Holcim, on why the world's biggest cement maker is a top gainer on the stock 600 today. This is Bloomberg. So Holcim, the top riser in Europe this morning after outlining plans to spin off its operations in North America. The chief executive of the world's biggest cement maker told Bloomberg why it's seeking a valuation of more than $30 billion for the new entity.
We have developed the most successful company in the building space over the last years, and especially in North America, we doubled the company in the past 4 years to over $11 billion with leading margins. And now our plan is to take that to $20 billion. To do that, we don't think to run the company like a subsidiary is the right way. We want to make it an independent company with strong U.S. leadership.
Now, Bloomberg understands that the UK government has asked City of London firms to submit proposals on a potential retail share offering of NatWest Group. The advisors have been asked for bids by late February, with the Treasury hoping to announce a share sale alongside its March budget. Now, the UK holds a stake of more than a third in the banking group, which was rescued during the global financial crisis. And staying with the UK, new data says job vacancies fell by the most in more than 3 years in December. Another sign of a red-hot labour market is cooling. According to online portal Adzuna, job postings dropped almost 7% last month, with early data suggesting January will see a similar-sized fall. Coming up, we discuss a record month in the debt markets with co-chief investment officer at PGIM Fixed Income. He's Greg Peters. We'll also look at some of the big news out of a lot of the central banks this week. We have Fed, we have BOE, and this is Bloomberg. Oil rises and tensions soar after a tanker carrying fuel is struck in the Red Sea, while Iran distances itself from a separate attack in Jordan, in which 3 U.S. soldiers are killed. A Hong Kong court orders the liquidation of the world's most indebted developer, China Evergrande, in a new test for the embattled property sector. Plus, Philips shares fall after the Dutch firm halts the sale of sleep apnea devices in the U.S. following a settlement over faulty equipment. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, companies and governments have flooded international markets with more than $700 billion of new debt this month. It's a record figure, showing that investors are eager to take on credit risk while yields remain high. Well, my next guest says attractive values can still be found in a number of areas, although much of the juice was already squeezed out of the bond market in the final 2 months of last year. Well, Greg Peters, co-chief investment officer at PGIM Fixed Income. Greg, I like the idea. First of all, good morning, but I like the idea of the juice being squeezed because it does sometimes, when you look at markets, really feel like that. So what are you expecting for early 2024 after, frankly, the pretty busy and interesting markets we had at the end of last year?
It is. I mean, the end of last year, we had this ferocious rally.
Yeah.
So you really seen this dip down in yields, spreads tighten, stock market's higher. And so, many feel there's not a lot left. And for sure, a lot was squeezed out, as I guess I said. But I still think there's value, right? We're still in this higher interest rate regime. Inflation is, coming down, albeit it's going to be more volatile. Not coming at the same pace, but we still see a lot of value in fixed income, and we actually think fixed income is still a place to be from a balanced portfolio perspective.
So, corporates or government?
Well, a little bit of both. So, as you mentioned, governments are issuing a tremendous amount of debt, so they have to fund these deficits. So I do think there's value there. But, certain parts of the credit markets also have value, but it's not like universal. You just can't lay on beta, I would say. So it's very idiosyncratic and very sector driven.
But Greg, I've never seen so much tension at Treasury sales at auctions than we've had in the last year. And I don't know whether there's an underlying belief in the markets, maybe if not spoken out loud, that at some point something will go wrong because of the amount of debt the U.S. has.
The fear around the deficit is amazing. I haven't seen it in such a long time. It almost pales to what we observed in 2012 with the European debt crisis. So investors are really worried about it. But it's one of these things where it doesn't matter until it matters. And so no one really knows, which makes it quite scary. But at the same time, I do think that narrative is a little overplayed at this point. Yes, there's a tremendous amount of debt. Yes, that puts pressure on yields, all else equal, raises risk premium. But I don't think it kind of changes a lot of the underlying dynamics. I
mean, I know, and when SVB went under, there was a lot of, chatter, which was, partly because of treasuries, but also there was a lot of chatter. It's always some mortgage-backed securities. I mean, it's not as simple as that. Do you still see value in that market?
I do. I mean, what we learned last year in March with the SVB crisis was more around how the markets price in central banks.
Yes.
So it was like instantaneous, almost a 200 basis point cut. And to me, that just didn't make any sense. At the time, we had 6% inflation. Growth was really quite strong. And so I still think investors are using this outdated playbook and think that any wobble in the marketplace, central banks are going to step in. And I think there's kind of a misalignment there.
And so what does that mean for opportunities?
Well, what I think it means is that yields are likely to remain higher than what investors think. This whole, front-end move down with central banks, being much more aggressive, I also think is, overplayed. What we feel comfortable in fixed income is actually the yield. And so we're calling it yield is destiny. So what we think is bullish around fixed income is actually the yield itself. So it's not a capital appreciation play as much as it is, as we say, roll and carry.
So, Greg, talk to me a little bit about some of the corporate issuance. Do you have, I think you split it in sectors, right? And financial issuance looks pretty attractive.
Yeah, so financials have been issuing a tremendous amount of debt as well over the past several years or so. So there's a real opportunity to buy it, of course. But their fundamentals are really strong, right? And the regulation is much stricter now. There's more capital, more controls. And so we take a lot of comfort in financials. What's interesting about the corporate bond market right now is that investors are really looking for long-end corporate debt at a time when issuers don't want to issue out that far. So there's this supply-demand imbalance. And so you're seeing this real flattening of the spread curves where there's not enough supply to satiate the demand in the back end. So, the curves are really flat. So we see value in 10 years versus 30 years and 5-year corporate. So we just think there's a lot of relative value across the corporate bond market.
Do you also look at AT1? I mean, they seem to be back with a vengeance.
We do. It was nothing but a bad dream, evidently, last year. So that's an area of the market that we have always been quite kind of skeptical around. It is a bond instrument with an equity kind of kicker to it.
Yeah.
And so it has a kind of negative convex component, and it's documentation heavy, which was learned last year. So, we think there's a lot of tourists in that market, kind of bid up those prices because of the desperation for yield. And with front rates where they are, I don't see that same kind of desperation. So it's not an area that I really see a lot of value.
Greg, anything else? I mean, so we talked about financial. Is there anything in healthcare, or is there anything in terms of corporate issuance that you'd stay away from in this kind of environment?
Yeah, what's unique about this cycle is the typical companies and sectors that are most exposed to a weakening cycle are acting different this time. And so you think about the consumer cycle, right? So one of the areas that have been really quite interesting is cruise ships. So cruise ships is an area that was completely decimated with COVID, highly cyclical, classic cyclical type of industry, has done really well. Autos, the same thing. So what's really interesting here is the uniqueness of this cycle and how some of the classic cyclicals aren't acting so classic.
But does it change? And I don't know how much. I mean, does the China reopening, or do you need to understand China to play some of these, or are they, fairly, like, if not secluded, are they standalone?
Yeah, so I think China matters less and less and less. If you rewind the clock to this time last year, there was all this excitement about the China reopening that really didn't deliver the oomph that investors were hoping for. I think this is the new world that we live in. Yeah. So it's not a China story. Yeah. It is more of a global story, of course, but not driven by China. And so I think that is how we think about the world going forward. Yeah. It's not this China-dominant type of story when it comes to these types of cyclicals.
Greg, what do you do with Europe? So we also spoke to actually the German finance minister in Davos, and he was saying, look, Germany always gets portrayed as the sick man of Europe. It's just a very tired man. Nonetheless, I mean, some of the economic data is just not good from Germany. And so how does that play into all of your Europe thinking?
Yeah, so, Germany is struggling here, candidly. And so I think one of the trends we've also seen over the past 12 months is the peripheral doing better than the core. A lot of it is energy driven, but I think, China has been, I'm sorry, see, that was a slip. Germany's caught between China and Russia in many ways, right? On both sides of the supply chain, input and output, and they're in a really tough spot. And so fiscal spending is something that should help them. They kind of picked it up. Now they're retrenching again. So I think Germany will continue to be a laggard here for some time to come.
Do you buy anything elsewhere? Are there any bond? I mean, you have election, you have European elections, many question marks about politically if it goes too far to the right or too far to the left. So is this the right time to be buying some of this debt?
Yeah, so you have 50% of the world population entering elections this year, right? So it is a big election year, Europe included. So I mean, we still see value in some parts of the peripheral part of the European market. So, Italy has really done well. Will continue to do as well? Probably not. Portugal, the same story. Greece is a country that we've been investing in, for quite some time, even during the darkest days. It's on a great trajectory. So I think one of the themes that we have is that the peripheral and the core are really coming together. As some of those core countries, they have to spend more. They don't have the same kind of fiscal backdrop as before. And so that's kind of one of the thematics.
Greg, thank you so much, as always, for joining us.
Thank you.
We went around the world. Greg Peters, our co-chief investment officer at PGIM Fixed Income. Now, coming up, President Joe Biden considers his response to a deadly attack on U.S. troops. We'll look at, of course, all of his options. That's next. This is Bloomberg. Well, U.S. President Joe Biden is weighing what could be one of the most consequential decisions of his presidency as he decides how to respond to a deadly attack on a U.S. base in Jordan. Well, we're now joined by Mark Champion, Bloomberg's international affairs columnist focused on EMEA. Mark, thank you for joining us. Realistically, what options does the U.S. have to cut through what seems to be an increasingly complex and also dangerous set of security challenges?
Yeah, it's really very difficult, and made much more so by the backdrop of the continuing war in Gaza. The interesting thing is that U.S. troops in the Middle East, they've been quite isolated for a while in Iraq and Syria, quite vulnerable, if you like, to attack. But in the months before October 7 in Iraq for almost a year, there really hadn't been much attempt to hit them. They had more than 100, perhaps as many as 160 attempts, since October the 7th. And the question for the U.S. now is, so how do we deal with this? There will be enormous pressure to go directly at Iran, which is seen and is the organizer of many of these militias. It provides them with weapons, with funds, it treats them as an axis of resistance. So we don't know exactly how, what role Iran might have had in ordering this attack. They said they had none. But for the U.S., for Biden, it's going to be very, very tough to balance this, because if you go after Iran directly, that's a huge escalation. And there's very little evidence that Iran would simply back off. It would feel that it had to respond. Anything that you do less than that is not going to really solve the problem. Again, we have long 40 years of evidence that it's very difficult to deter Iran in that way, and it will not satisfy people at home in the middle of an election campaign. So a very, very tough calculation.
I was going to ask you, Mark, how does the U.S. election, because we're in full campaigning mode, how does that change what President Biden is thinking?
Yeah, I mean, it's going to play a significant role. It cannot do anything but. Republican, critics of the American policy on Iran, it's not like that they suddenly emerged and developed their, deeply held beliefs just because of the campaign. But immediately they came out and said, very clearly that they think that this is all Biden's fault, that he's been weak, that the responses that he made so far to attacks on American assets in the region, where there have been many, and the attempt was there to kill Americans. It's just that it took until now for a group to succeed. So they're going to play this for all of the political capital that they can. And the president is going to have to, think about that when he's calculating what to do. For example, if he wanted to do this in what would perhaps be the most effective way, which would be to do it in a covert manner, to hit some asset of the Iranians, which is, connected and valuable to them, so it would, make them think twice. That would not do what is needed for him, politically. So that does complicate things.
Mark, thanks so much. Mark Champion there from Bloomberg Opinion, our columnist. Coming up, Ryanair lowers its guidance, saying the battle with so-called pirate websites is hurting profit. We'll break earnings from Europe's biggest low-cost airline next, and this is Bloomberg.
Is taken into the guidance, and actually that is also taken into the 3-year plan guidance for 2023 to 2025, where actually this is now in. Now what is not in, and that's also something you alluded to, are two pieces. One is litigation, where we said earlier that we are working through getting further insights, and we hope hopefully later in 2024 to get more insight into the cases and to provide that. Secondly, it's the DOJ investigation that's also undergoing, of course, under full control of the American authorities. And we said that that would not become clear before 2025.
OK, so we will have to wait till 2025 to get a little bit more clarity on that front. When it comes to that agreement, then, the decree with the FDA in the US, how long do you think it will take for you to meet the relevant requirements of that consent decree?
So as I said before, there's timing of a consent decree which normally spans between 5 to 7 years on a totality. But actually what is important for us is this provides a roadmap for us to comply. And the moment we comply earlier, also you will see that we could come back earlier into full business in the US. I think it's also important to clarify that we continue to remain servicing our sleep and respiratory care patients in the US with patient interfaces, with services. And outside of the US, we're fully back where we are also providing respiratory care and sleep devices, new ones, as well as all the accessories that go with it. And I think the other bigger piece for us is that the totality of Philips has now the clarity, because yes, SRC is really important. We will be focused on complying and restoring the business, but we need to get the 80 billion really back into full performance gear. And therefore, the 7% growth last year, the 3 to 5% next year will be important to achieve, because then we can deal with any consequences of sleep and respiratory care. And most importantly, we can support the healthcare sector with the solutions that we have.
Specifically, how much will you be putting aside for personal injury claims?
So as I mentioned, the litigation is something we are working through. We are getting further insights into that. We have not provided for any number because we don't have that clarity. Firstly, it has to be seen if there needs to be something to be provided, and then if there's something to be provided, what is it based on? So that's something that is in process.
Philips chief executive there, Roy Jacobs, speaking to Bloomberg a little bit earlier. Now, Philips shares falling after the Dutch firm halted the sale of sleep apnea devices in the U.S. following a settlement over faulty equipment. Now, Ryanair has also lowered the top end of its full-year profit forecast after third-quarter revenue narrowly missed estimates. Now, the low-cost airline has been hit by higher fuel prices and delays in deliveries from Boeing. Well, the chief financial officer, Neil Sorahan, told Bloomberg that he still has confidence in the U.S. plane maker.
No, I think in fairness, they are improving. I think things are moving in the right direction. But, they just need to make sure that, we're getting high-quality aircraft on time, all the time. And I believe that Dave Calhoun and Brian West are the people that are going to deliver that.
OK, you have confidence in the team?
I have confidence in the team, yes.
Well, we're joined by our reporter, Kate Duffy. Kate, I mean, interesting, really fascinating to look at Ryanair. So clearly a few challenges for Ryanair.
Yeah, absolutely. So as you said, Ryanair have narrowed its full profit guidance for the year this morning, just slightly. But this is partly to do with the removal of their flights off online travel agent sites in December. This was a sudden and unexpected removal, but something that Ryanair wanted. And as a result, their load factors dropped, and they had to cut their fares in order to encourage passengers to book through their website. So this was partly to do with that, but also this time of the year, it's one of the weakest seasons for airlines like Ryanair, who are leisure airlines. They make most of their money in the summer, and so especially in Q4, that's going to be a weaker time for them. But of course, this comes at a time when Ryanair are suffering from Boeing delivery delays. They are expected to get about 50 out of the 57 that they previously expected by summer. So there's a few things going on in the earnings this morning that investors will be concerned about.
And Boeing, I mean, it can't seem to catch a break. I mean, it's like, frankly, challenging news after challenging news, and they report on Wednesday. So what are you looking out for?
Yeah, so I think analysts, investors, also customers will be looking out for the impact of the MAX 9 grounding and the actual cost of that as well. And also the FAA's decision to stop Boeing from ramping up production. And all eyes will be on, as I said, how much this will cost and the total impact of that. Airline CEOs, some of them have come out and said that, criticising Boeing, calling it out for the lapse in quality control. But the likes of Ryanair are confident about Boeing and say that they have improved their quality standards over the past couple of months from what they've seen with their aircraft in particular. So, all eyes will be on the impact of the grounding and the FAA's decision.
So is it possible that Ryanair is interested in like a second-hand fleet of Boeing from someone else?
Yeah, absolutely. So that's what the CFO said this morning, and also O'Leary on a company presentation. They said, if United wasn't interested in their MAX 10s anymore, which is what they've suggested, they would take their planes. So it remains to be seen what will happen, but it is a possibility.
I love that. It's like an offer. Michael,
Absolutely.
always out for a deal. Thank you so much, Kate Duffy, there, aerospace reporter looking at airlines. Now, some of the other movers that we're watching out for today, Holcim actually rising. This is on the back of plans to spin off its North American unit. This is the world's largest cement maker, and it said it plans to separate its fast-growing North American business to pave the way for a listing next year in the U.S. That would be valued at more than $30 billion. Buyer shares actually down in today's trading session. This is after the German conglomerate was ordered to pay $2.2 billion to a former Roundup user who blamed the weed killer for his cancer. And then finally, Philips falling after suspending sales of sleep apnea devices and ventilators in the U.S., and this comes after an agreement with the U.S. Food and Drug Administration over its faulty medical equipment. The shares falling almost 6%. Up next, a Bloomberg Brief with Manus Krani in New York. It's a big week. Stocks are kind of on tenterhooks. It's a big week for markets. A lot of earnings, and of course, we have a lot of central banks action. This is Bloomberg.